Sure. So we looked at a lot of historical data, and we found that historically, when you look at some structural themes, which play out over a very long period of time, and are not very tactical or cyclical in nature, you find that companies which are innovating, spending a lot of money on research and development, either creating new markets or trying to capture the existing market share by doing something differently, whether it is execution or the product or the service. Generally, we've seen these kind of companies command a huge market share or higher profitability, and thus their investment returns are also very, very high. So a case in point is, for example, when steam engines came about and the first industrial revolution happened, or when electricity came about, the automobile engine IC came about, right? The tires came about. All these happened, together in about 1880s to 1910. There was a very large economic boom. We call these technologies general purpose technology, a technology which impacts the economy as a whole. And when you go and see these periods, when these technologies take shape, they are generally, followed by very, very strong investment returns, because economies undergo a huge amount of churn and new businesses come about. So innovation in totality has been a very structural theme. It gets about, it gets a number of bouts of, good periods where a number of technologies come about. Right now, what we are seeing over the last 10 years, a number of new technologies are coming on the block which can change how economies operate, how businesses operate. For example, a blockchain technology or artificial intelligence coming together, robotics being used in industries, warehousing, uh, many other fintech technologies which are coming up, which, for example, one very, very crucial is UPI itself. Maybe blockchain is a much wider decentralized version of that, right? Many other technologies which are being utilized, for example, gene technology or genome sequencing, another technology which is coming up. We feel these 8 to 10 technologies in the future will change how economies function, and therefore it will create new market leaders which are not present today. They are not very large in nature, their market sizes are small, but they have very, very tremendous tailwinds behind them right now. Just to give you one very simple example, a small payments company like Square, which is now getting renamed as Block Incorporate, which started, at about $200 million of revenue in 2012, has reached about $17 billion in revenue in 2021. So this kind of tremendous growth rate will also result in huge profitability going ahead. So to capture such themes and this disruption which is happening globally, we think innovation is one of the most structural themes between, let's say, 2020 and 2030, where all investors should pay attention to. See, largely when you think about innovation and when you see these companies, for example, let's take example of some prominent companies. Let's look at Alphabet, which is the parent for Google, or let's look at Apple. These companies are incorporated in US, but their businesses drive their revenue across the world. For Apple, the biggest market, US or China or Southeast Asia, put together, many of these markets are very, very large in size, right? So their country of origin or incorporation is not very relevant. Similarly, for this overall fund, although when you look at the geographical split, about 80 to 81% companies are incorporated in US, about 4 to 5% companies will be from Eurozone. Rest of the companies are from across the world, including Japan, Taiwan, maybe one or two companies from China. So the larger mandate is to look at companies which drive revenue globally, and that's how you look at this overall underlying, theme, rather than looking at the country of incorporation for these companies. So one of the feeder funds that we are using used to have one or two Indian companies earlier, and it is entirely up to them. But there are mandates, regulatory requirements which we have to adhere to, and the fund cannot go beyond those mandates. So looking at those mandates, it is still open to invest in Indian companies. But when you look at innovation as a basket, India is still far behind. We are still in our listed space, there are not many opportunities to play. For example, if you want to play metaverse, there are not many companies that you can pick, right? From where we have, for example, if you want to play semiconductors, there is no listed company in India where you can play this theme through. So it's very limited, and that's why it also makes sense that if you want to invest in businesses which are going to create our future, you have to look outside of India from a global perspective. Largely, when you look at, let's say, a US flexi cap, that is more equivalent to a domestic flexi cap fund, which is geared towards US market, looking at opportunities across market caps. This fund is the one that we are chatting about, Global Innovation Fund, is particularly focused to capture companies which are creating the future. They are creating new technologies going into different arenas. Some of them will be represented in other funds also, but not many companies. So, for example, there are certain small and mid cap companies, certain companies which they are bought just when they IPO, and they are looking at various sectors which may not be very large today, right? For example, I'll give you an example of, let's say, genome editing. Gene editing is a technology. You would have seen advertisements where people ask for a 10 crore, 20 crore injection for their loved ones, that they are not able to afford. So these technologies are very small right now. Their cost of cure is very, very large. Scales are very, very small. Their representation in the indices is almost zero. They are not large cap. They are small or mid cap companies between, let's say, $5 billion, $13 billion, $20 billion kind of market cap in US. So which accounts to about small and mid cap type of companies. When you want to allocate in such companies, which are probably looking at growth in terms of profits and revenue 3 to 5 years from now, those companies may not get adequate representation in the more frontline themes or frontline schemes like a flexible equity theme. So they are different, and this fund is more focused and geared towards capturing the innovation part. In terms of allocation, I think all the three can sit into allocation depending on what kind of exposure do you have to domestic and international equities. This, I think, is a very, very stable theme. Over a period of time, it can have a sizable allocation in the overall scheme of things, including the other two that you spoke about. Sure. So this fund is, it's good that you asked this question. This fund solves a very, very important risk when you invest in innovation, which is not to get very, very narrow in terms of the theme that you use. For example, if we were sitting in 2000 and talking about, let's say, internet and technology and investing in that theme, it would have taken 8 to 9 years for us to break even, right? Because stock prices were very, very high. So it exposes you to a very, very specific kind of narrow theme. What this fund does is it goes beyond one sector. So it is going to invest, let's say, about 29% in semiconductors, about 24% in software, about 7% in e-commerce, about 7% to 6% in biotechnology and healthcare, about 4% in mobility, about 5% in fintech and payments, maybe a mix of 10% in smaller themes like robotics and warehousing. So it's a very, very well diversified fund. It goes across themes and sectors. What it will avoid, generally, I don't think it will avoid commodity sort of sectors. It will avoid those sectors where the business models are very, very commoditized. There is no innovation. The R&D spend is low. For example, mining a metal out of earth and selling it. This fund probably will not look at companies which do that, or let's say called resource companies generally. And it will also not look at the old normal models which operate in the market today, which are probably becoming redundant and over a period of time will be, I think, only simple commodity businesses. So this is the overall purview of the fund today. So as you know, when you look at equity markets, in totality, whether it is, let's say, an S&P 500 and Nifty, or any other equity indices globally, over a short period of time, they do move together in terms of correlation. But over a longer period of time, let's say in a 10 to 20-year cycle, they have very, very divergent performance, right? From 2000 to 2010, Indian markets performed brilliantly. Between 2010 to 2020, US markets performed very, very well. So these differences will continue. this theme particularly, which is global innovation, as I said, is very, very global in nature. It's not very country specific because these companies drive revenue from across the world. So the correlation in that sense will be lower, because these companies have profit pools across the world. So they will get impacted from what is happening across the world. In that sense, the correlations will be low. And as you know from recent history, when India was not doing well between 1819, many other countries were doing well. Many of these companies were multiplying. Some of the themes, for example, global disruptive innovation returned a CAGR of around 45% over a 4-year period, before 2021, where India did not so much well, in comparison to pre-COVID and post-COVID levels. Our performance was much more muted. So the correlation will be lower because of the type of theme that we are playing, type of companies that we are buying, and it will be a good mix to add to our portfolio. So the best vehicle that we see to play this theme continues to be SIP. I think because the reason is that it will bring an automatic discipline. Plus, we've seen that innovation as a theme is more volatile. As you just pointed out that in last 6 months, many companies which are particularly toward disruptive innovation saw a correction, a deep correction. Correct. And before that, they saw a very, very strong rally for 4 to 5 years. So inherently, this theme is more volatile than let's say a very, very frontline large cap kind of a theme. And the reason is that these companies, some of these companies are still unproven, right? They are trying to create their own marketplace. They're trying to create their own business model and profitability. So they will be a little more volatile in terms of their price movements. And therefore, SIP route, I think, is much more favorable and suited. Lump sum returns could provide you more volatile experience. And therefore, I think continuing a perpetual SIP in this kind of a fund over the next 10 to 20 years, I think it appeals to me as an excellent strategy to deploy. I think it's an excellent question, and I have thought about it myself also. So when we look at our international allocation, we generally stop close to 10%, saying that kind of allocation will add to certain uncorrelated asset to our portfolio. Some people also go higher. But the point is that when you look at the overall portfolio that we have today, and then you think that in, let's say, how will the world look in 2030? The disruption which is happening in, let's say, automobiles, which is happening in banking and finance as a whole, which is happening on the internet. We are talking about Web3, we are talking about metaverse, disruption which is happening in our consumer durables. Our fridges have computers now. We can talk to them. We can play music on them. Our cars are becoming more and more digital in nature, right? And when you see these technologies and changes happening, and then you look at your portfolio, do you have the plays to capture these new technologies in India in your current portfolio? The answer to that is no, as of now. There are very few plays which can capture these technologies of the future. And therefore, I think this Global Innovation Fund will fit in well, where you can look at it from two ways. One, your international proxy, take some exposure in terms of how international proxy will play out through this portfolio. And secondly, also look at what my India allocation is and how much of that I want to devote to these technologies which are now shaping up every industry. Eventually, India will also have some of these companies over time, but as of now, it doesn't have representation. So I think these two put together will probably take you to closer to 10% or higher. And I think that is probably an ideal mix to start with. But of course, I think a financial advisor will do a better job than me giving any ballpark number.